You're listening to Macro Sunday. Sunday podcast. I'm Andreas, Steno, founder and CEO of Steno Research, and I'm back in lovely but cold Copenhagen, and that's why I am dressed like Bear Grylls in the studio here for those of you watching on YouTube. It's cold as beep here relative to Spain, where I spent the last couple of weeks, but it's great to be back, and what a timing to discuss US Treasury markets again. We've had a couple of bizarre weeks in US Treasury markets with loads of volatility, and therefore we'll spend the next 30 to 45 minutes on US Treasury markets. And I'm joined by, first of all, you, Emil Moller.
Cheers.
My true lieutenant in this discussion. You've been writing over and over about this treasury market over the past week.
Yep.
So I'm very curious to hear your takes on what's ongoing in that market.
Definitely.
We'll be joined by one of our best friends of the house, I'd say, Mr. Bob Elliott, former co-CIO of the Bridgewater hedge fund, now founder of Unlimited Funds, to discuss his views on the US Treasury market. He's one of the best sort of cross-asset allocators I know, and I really look forward to that discussion as well. And in a second, we'll be joined by our partner here, Mikkel Rosenwald, as well.
Yep.
He's the head of geopolitical analysis. That was a tricky word, here at Steno Research as well, to discuss the ramifications of everything ongoing in the Middle East for the US Treasury market.
Yep.
But before we get to all of the great content, just a brief and friendly disclaimer/reminder that the trade ideas discussed in this show might be good old Gennaro Gattuso. I think it's the best disclaimer in the world, this one.
It's definitely honest.
Exactly. And I'd also like to remind you that if you like what you see, if you like what you hear, please go visit stenoresearch.com to find out more. You can use the code MACRO30, MACRO30, to get 30% off your subscription. That is an exclusive offer for the audience of this show. We'll leave the link and the coupon code in the show notes. With that said, Emil, US Treasury markets. Jesus Christ. Back and forth. The beginning of the week, last week, curve steepening again. We briefly traded above 5% in the 10-year point in the Treasury curve. Yeah. Now we're lower again.
Yeah.
What do you make of all of it?
Yes, loads of uncertainty, and I think the market can't quite get its footing at these levels. I'd be surprised if we see the 10 years swoop up, say, 550. That would surprise me. It's not out of the question.
No.
Given recent months and everything else, but I think it's just swing trading at this point, probably with a tad with a tad pressure on the yields to push up a bit in the near term, but before we see a significant reversal, which I think is imminent.
Emil, we release this podcast on Sundays, obviously.
Yeah.
So tomorrow, the QRA is out.
Yeah.
And for those of you who are not familiar with that abbreviation, I think it's an abbreviation for Quarterly Refunding Appendix. Is that correct?
Yeah.
So it's basically the report from the US Treasury on the sort of expected issuance profile, the expected cash holdings, all of that for the quarter ahead. Yeah. So, Emil, you looked into the sort of expectations for that QRA report, but also made up your own thesis around what they will communicate. So please enlighten us.
Yeah, sure. So first and foremost, and I think this probably speaks into the political discussions we will have later on, I think there's a significant incentive for the US Treasury to start keeping the current level of the Treasury General account at a higher fixed level.
So basically their cash buffer held at the Federal Reserve, the amount of cash that they hold idle in case of emergency.
Exactly, and there are a couple of reasons here. First and foremost, we have the debt suspension coming next year. Next year again, technically, it's on 1st of January of 2025. Secondly, one could argue that you need some sort of buffer given all the geopolitical turmoil we see at the moment, and the war spending, all that sort of thing. That would probably require some cash in, and perhaps more imminent, the Congress is not really cooperating with the administration. So you have kind of a pressure to keep a high funding level at this moment in time. And I think that given the way yields are at the moment, I think they will probably push on issuing more notes than what they usually do, and they're already above the guided.
So basically
threshold.
shorter on the curve.
Exactly.
Yeah.
And obviously there's also a bit of a fiscal incentive here, because you're committing a lot of debt expenditure if you go out on the long end, right?
Yeah.
So I think everything is pointing in that direction. But I think what is really the most important thing for markets is I've looked through, and this is not really the QIA thing, but the expected deficits from the last quarterly report, and I think they are below what my expectations are.
Yeah,
I think we would see, consensus among both dealers and various state departments is around 1.5 trillion in deficit. I think we will see a higher one for next year than that, probably 250, maybe even 300 billion more. And that's really what's going to push yields here. Unless we see some fiscal consolidation, but right now, not much sign of that, at least for now.
No, I perfectly agree. And essentially, the discussion on whether they need to hold a larger cash buffer is also related to the size of the deficit.
Yeah.
Because the whole point of a so-called Treasury General Account is to have cash readily available in times of turmoil where you cannot issue, for example. Take the pandemic as an example. A lot of stress and turmoil in the market. You spend the cash you hold idle before issuing, allowing the Fed to sort of calm the waters before you issue. And when you run a deficit of, say, 8 to 10% of GDP, you simply need a larger cash buffer compared to a scenario where you run a deficit of 1 to 2% of GDP. That's obvious.
Usually, yes.
So I basically lean the same way as you, Emil, that we've grown accustomed to, say, levels of the TGA around 600 to 800 billion.
Yeah, I think that's the new floor. Around
yes,
there, at least.
And plus 1 trillion looks likely all the time here.
If you're going to battle with the Republicans on debt issuance, do you want to come in with the TGA at that level coming next year? I doubt
Probably
it.
not.
It's an election year as well. I mean, you want to be able to afford some presents, right? In the run up, and Biden has quite a catch up to do. So I think
so. Get your wallets ready out there. A lot of issuance is coming. And the issuance pace is also related to geopolitics at this juncture. Obviously, with everything ongoing in Israel, Gaza, but also with everything ongoing in Ukraine. So let's listen to a small soundbite from a favorite of ours, at least from an entertainment perspective. President Donald Trump, at least in his own mind, he's still the president.
In our podcast, he still is.
He's talking about how this situation would have evolved had he been the president at this time. So let's listen to him.
Okay.
I was also the only president where Russia didn't take over a country during my term. Russia took over not because I got along with Vladimir Putin very well. I said, Vladimir, don't do it. You and I are friends. Don't take over any countries because, Moscow will be hit very hard. Well, I told him things. He probably didn't believe it, but you know what? He believed it 10%. And President Xi believed it when I talked about Beijing. He probably said, I don't believe him, but there's a 10% chance we're not going to do anything. It's true. It's true. You have no idea. These conversations, I wish they could have been recorded, actually. People would think a lot of me. But with Bush, they invaded Georgia, right? With Obama, they took Crimea. With Biden, they're trying to...
He's not totally off, you know.
No, he's not totally off. But I think this is the perfect timing to introduce Mikkel Rosenvold, our geopolitical analyst here at Steno Research, to the podcast as well. And Mikkel is a joint technician and a geopolitical strategist in this podcast. So that's why you came walking into the studio while we were listening to Donald Trump here. Mikkel, first of all, this notion from Donald Trump that if you say crazy things to other state leaders, they may interpret that as, in his own words, a 10% risk that he's mad. Do you think there's something to that notion? Is it fair to assume? Yeah,
absolutely. And that's the thing the entire U.S. state apparatus used during the Trump administration. The entire Foreign Office sometimes had difficulties aligning their policies with Trump. They had strategies. He would go off, taking individual meetings that they had no way of preparing. But they could still use that. They could use the notion that no one knew what Trump were going to do. So you basically had to negotiate with America on a number of issues. Of course, he's putting it to the extreme here. I don't think the Chinese expected him to nuke Beijing or Putin, but still, there was an element of a rogue agent here. No one knew exactly what he was going to do. They attacked Syria. They attacked, they killed General Soleimani in Iran, for example, which was a huge shock. So they also demonstrated this ability or willingness to make sudden strikes and sudden moves. So there is something to it. I don't know if I completely agree with Trump on this, but yeah, to some extent.
But Mikkel, back to the discussion on the link to the US Treasury market, because we've had the election of a new speaker. Over the course of the past 7 days. Mr. Johnson is now the Speaker of the House after a very turbulent process, to say the least. So, Mikkel, this new guy, Mr. Johnson, the Speaker of the House, should we expect him to allow Biden to continue to spend? What are sort of the main takeaways from this?
Well, no. I mean, Johnson is part of the mainframe Republican caucus, the Republican Study Committee. So he's not a Freedom Caucus guy. Oh. But he was accepted by the Freedom Caucus because he is to the absolute right of the center of the Republican Party, if you will. He voted no on supporting Ukraine. He voted no on confirming the election results. No on same-sex marriage. No on the intermediate funding bill. So he is absolutely a right-wing MAGA Republican, a staunch Trump supporter, of course. And he will be a very fierce opponent in the upcoming appropriations and budget talks. One thing that I personally have been looking a lot at is his views on Ukraine, which have been spreading throughout the Republican Party. Basically, that they're using Ukraine as the bargaining chip. They want to cut the aid for Ukraine in some effort to save the budget, which makes no sense if you look at the numbers. But in a symbolic sense, it might make some sense. But Johnson obviously voted against supporting Ukraine. He's been very clear that he wants to use this as a bargaining chip, but he has opened for the notion that he can negotiate with President Biden and the administration in this. So I do expect some sort of compromise. Still, can he remove himself from the Freedom Caucus? Can he remove himself from the people who basically just want to watch the world burn or watch Washington burn anyway? That's the main question for me.
Yeah. And we have a potential new source of funding / issuance for the US Treasury to deal with, namely Israel. I know Johnson mentioned Israel very early in this election process. Mikkel, what's his take on the situation there and whether they need funding?
Israel is both. First and foremost, it's a very, very new conflict. When the Ukraine conflict was very new, there was broad acceptance of the need to support Ukraine. And Israel is just another matter. I mean, the lobby surrounding Israel, the support for Israel is massive within the U.S. Congress, especially in the Republican Party. So I don't think they're going to be using that as a bargaining chip. No. The question is whether Biden can link the Ukraine war with the Israel-Gaza war. It's a bit of a stretch. There are some links, obviously, between Russia and Hamas. They held a meeting the other day, actually. The leadership of Hamas were in Moscow. But it is a bit of a stretch to link these two. But the support for Israel is going to be off the table, basically, out of the question.
And Emil, when we look at the demand for US Treasury outside of US borders.
Yeah.
And the links to these conflicts, both in the eastern parts of Europe and in the Middle East now.
Yeah.
Is it something that we can see in the numbers from a demand perspective? Are foreigners buying fewer treasuries?
Yeah. I think that, well, there's obviously the hedging side of things, right? And the yield curve being inverted sort of puts on hold on a lot of demand from the outside. But when push comes to shove, I think they will dig in again, and so will the CTAs and the pension funds and all that. So on a longer term basis, I'm actually not too worried about the demand side, despite there's some immediate concerns when it comes to foreign demand, as long as the yield curve is inverted. And if I might add, Mikkel, and this is a suggestion for your household back home, actually there's a substantial academic literature that goes to show that if one party in a negotiation is unpredictable, the other party would be more willing to concede ground. So never let your wife know where you're about, and you will get the long end of the stick. Just in terms of...
I told Vladimir.
Yeah, exactly.
One note on the war fundings, and this is a bit more long term than most of you will probably be looking at your investments in the light of. But Europe is basically, as I see it, getting ready to rebuild Ukraine now. The US has been funding most of the war, but Europe is getting ready to accept Ukraine along with a number of other countries as new member states of the EU. It's going to take 7, 10, 15 years, but the desire to take them in, even though they do not meet all the standards for the judicial system, etc. And that's basically Europe telling everyone, we're going to rebuild Ukraine. The US might have to finish funding the war, and we might have to do some peace term at some point, but we're going to rebuild Ukraine.
Yeah. And a point in relation to that is that the bond program issued by the European Union itself could easily be used to channel money to Ukraine. That would be something that you could probably gather consensus around within the European Union. And it is also something very concrete. When the EU started issuing bonds during the pandemic, it took at least 18 to 24 months before those funds actually channeled out to some of the member countries, because you have all of these bureaucratic processes where you need to figure out who should be on the receiving end first and foremost.
You need
That's
to write
tricky.
the name of your neighbor's dog in the application form before it even gets to the desk, right?
And I mean, it's very easy to just send the money to Ukraine, right? And I think that's a very likely scenario, that the European Union will issue bonds to channel money to Ukraine for the rebuilding process, not for the war.
And that's the thing. The one thing the EU bureaucrats cannot solve is the 300,000 Russian guys with guns standing on Ukrainian soil. That's still the crux of the problem. And no matter how many bonds or EU directive you issue, that's still the problem.
Yeah. With those words, I think it's time to invite Mr. Bob Elliott to the Macro Sunday floor here. His background as a co-CIO of Bridgewater Associates, his current role as the CIO of Unlimited Funds makes him a perfect guest for the discussion on how to view the moves in the US Treasury market relative to other asset classes. And I think it's safe to say that Bob is a bit puzzled why equities are trading up here, given everything that we've seen in yield space. So, Mikkel, I'll allow you to move back to your role as a technician, because we need to introduce our guest of the week with a piece of music, as per usual. And I think it's safe to say that Bob Elliott is on my top 3 favorite Bobs out there, but he's not number 1. Because the notorious weed smoker Bob Marley is my number 1. And since Bob Elliott is, I think, born and raised in New York, at least he's living there, the new weed capital of the globe. Let's play a bit of Bob Marley, Three Little Birds, to introduce Bob Elliott to the Macro Sunday podcast again. Bob Elliott, the founder and CIO of Unlimited Funds, once again to the Macro Sunday podcast. It's great to see you again, Bob. Thank you for joining us once again.
Hey, thanks for having me. I feel like a lot's been going on since the last time we caught up here on the Macro Sunday podcast.
Indeed, but I think you've been more or less smack dab correct in your market views since we hosted you the last time. We've had continuous turmoil in treasury space. We're starting to see the spillovers to equities. So I'd actually like to start with a sort of playbook that you've retweeted earlier today with 7 steps from your playbook to the global macro environment. Please fill us in on these 7 steps, Bob, and why they matter.
Yeah, well, I think this sort of playbook, I started talking about it when people were starting to we're thinking it's time to buy bonds because I think sometime in the future a recession is going to hit. And I took a step back and I said, look, there's a set of cause-effect steps that are going to take us from where we were, say, in the spring of last year, this year, to a point in which we get recession, and then eventually a point in which inflation is meeting the Fed's mandate and the Fed can significantly ease. And so I outlined those steps. The first step at the time, rates need to rise. And we've basically seen that, right? Rates are up more than 150 basis points since in the last 6 months, particularly on the long end, which hadn't sort of complied with the tightening that the Fed had been doing, bringing up the short end. And so we've seen the rate rise. The second step is stocks fall for 2 basic reasons. One, stocks fall because there's a direct translation effect from the interest rate rise to discounting of future cash flows, which should bring stock prices down. And 2, interest rates rising should lead to weaker economic conditions in the future. We've seen a little bit of that so far. And the reason why that is interest rates have risen a fair amount, would have implied something like a 20-ish% decline in stock prices if you duration match them. But we've only had a modest decline in stocks, about 10% from the peak, depending on exactly how you look at it. Then the next steps are relatively clear, which is that rise in rates and fall in stocks leads to demand slowing. That demand slowing leads to earnings deterioration. That earnings decline leads to weakening of labor markets. That weakening of labor markets leads to lower wage growth. And that lower wage growth eventually leads to inflation coming down towards the Fed's target. And so if you think about where we are in that cycle, we're sort of halfway in between two. And it's important that you remain disciplined through this sort of environment because you don't want to get ahead of these dynamics on expectations of something that might happen in the future, because you have to have these linkages play out to get to the final point where we bottom in economic activity and see a renewed reacceleration.
We've just had the latest press release from the European Central Bank this week, Bob, and it seems like the European Central Bank communicates that they are now at peak interest rates. It may be that the Federal Reserve will decide to sort of mirror that communication in a month or two. But the question here, Bob, is whether we are already at peak interest rates. That's basically the first step in this 7-step ladder in your playbook. If you look at interest rate markets over the past week here, we've seen plenty of action further out the curve than in the short end. So what do you make of the dynamics in interest rate space here?
I think the short story is across all these central banks is basically they're done. I mean, it doesn't mean it's impossible that they would never raise interest rates if oil prices surged or there was significant renewed inflationary pressures. But I think what they're basically saying is like, look, we've delivered 400 or 500 basis points of tightening. That's a lot of tightening. We expect that will be sufficient to create enough of a turn in the economy to slow inflationary pressures, combined with the resolution of some of the supply side issues which have occurred. And that, as a result, it's more prudent to sit and wait at this elevated level for longer rather than continue to hike, given the classic concern, really, that they might hike too fast to tip the economies into recession. And so, I think basically the question now for most of these central banks who don't really want to be pegged as the ones that caused the recession is, number one, how much will the long end have to rise in order to actually get that turn in the economy, which is, essentially what the Fed did. Like 6 months ago, they basically said, we're going to keep hiking a little bit, but like let that long end do the work for us, not the short end anymore. And same to a lesser extent in the ECB. And I think the second question is, just how long will they have to wait it out basically until they start to get that inflationary pressure down? I think there's sort of two things that they're missing. One, odds are that economic conditions will have to be a lot weaker than they expect in order to get that inflation down. And number two is they may not have tightened enough to sort of break the back of that more structural inflation pressure. So it may reemerge in the future, even when it's not particularly desirable.
Bob, if we look at that curve steepening that we've seen, say, over the past 4 or 5 months here, both Powell last week and Lagarde from the European Central Bank this week basically welcomed that curve steepening by saying that it helps us sort of in our transmission of monetary policy to the actual interest rates that matter for people and corporates in the real economy. So what do you make of that communication? Is it basically, say, a green light for further curve steepening here?
Well, I think it's certainly an indication of their preference, which is they were pretty worried that they would have to just keep hiking on the short end, to infinity in order to get the sort of tightening dynamics that they really desired. And the long end complying with their wishes, not really for reasons that are of their doing, but in part related to recognition of large fiscal deficits and a continued decent economy. That's really what's driving that long end. It's not really their behavior, but they'll take the win when they can, because basically what it does is it means that they can point to the long end rise. Market-based forces have created the sort of tightening that is appropriate for the economic conditions. It's not the central bank's behavior. It's the market that's doing the work here. And so I think the basic idea is, given that they're likely not doing much on the short end, they are sort of free to let the long end rise as much as is necessary in order to get that slowing. Now, I think, some people are talking about yield curve control and all that stuff, like the types of moves that would have to happen on the long end before any of these central banks get concerned about what's going on is significant. So, I mean, a flat yield curve is fine in the US, right? Maybe if we got 2 or 3 or 400 basis points of steepening and the Fed wanted to get easier monetary policy going, they'd implement that sort of behavior, but no time soon. They're happy to let the market do the work that's necessary.
Speaking of yield curve control, we'll get to Japan in just a second, Bob. But
that was a lead-in for that that question for you.
Exactly. I love it, Bob. But before we get to the Japanese central bank and the yield curve control in Japan, I'd like your take on the so-called uninversion of the US Treasury curve. We've seen large parts of the curve now being back in a positive sloping territory after the re-steepening, especially seen in the far end of the yield curve. So, Bob, the trillion-dollar question here is whether the yield curve uninversion is something that you can use as a recession predictor. We've had plenty of debates ongoing online on this question, but what's your take on the yield curve as a recession predictor? Is the uninversion something to care about?
Well, I think the uninversion reflects the fact that there has been a market-based tightening, right? And that market-based tightening is a precondition to getting a recessionary outcome. If we go back to those 7 steps, right? That's kind of how I would think about it, rather than there's nothing sort of like particularly unique about the yield curve in terms of what it does or its economic consequences. It's really about what is that balance, what does that long rate rise mean for, in particular, for risky assets. And I think that's the thing that is the sort of critical thing to think about as an investor. We've had essentially a 50% drawdown in bonds so far, right, from peak, a lot of which has happened in the last couple of months. But when you look at stock prices, stock prices are 10% off their nearby highs. Like, who cares? Stocks go up and down 10% all the time, right? It's like not it doesn't even trigger a thought in people's minds. And that imbalance between the significant repricing, essentially, of the term premium in bonds, right? We've gone from a deeply negative term premium to a modestly positive term premium, has just not been reflected in equity prices. And so either in equities, you have to believe that there's going to be extraordinary, and when I say extraordinary, I mean double-digit year-over-year growth in earnings, or you've got to have stock prices come down. Like those are the two things that are going on there. And so I think that's probably more indicative of the yield curve uninversion is more indicative of the fact that we're getting that asset price decline, that rising of the term premium, which has been priced into the bond market and now has to be priced into the stock market. And once it gets priced into the stock market and you get that equity market decline, that's when you start to get the real move down in the economic cycle here on the backside.
Bob, if we look at the Japanese yield curve control in relation to this discussion on the curvature of the US Treasury curve, I've been to Japan several times to meet pension fund managers, lifers, and so on, discussing fixed income markets. And one thing that's very certain is that they always look at yields on an FX hedged basis, more or less all of them, meaning that when there is an inverted curve in the US, it's very tricky for the Japanese life and pension funds to actually buy US Treasuries when they have to FX hedge them back to Japanese yen. So basically, you receive the spread between dollar rates and yen rates in, say, 10-year space, and you pay the front end. And when the curve is inverted, it's simply not a good equation seen from Japanese soil. So this decision on the yield curve control in Japan, how much do you think it matters for global fixed income?
Well, I think it doesn't matter that much for the U.S. markets, as an example, mostly because all those Japanese hedged buyers have been nowhere to be found for since really the yield curve got anywhere close to inversion. So what has it been? It's been more than a year that they just have been out of the market, letting whatever positions they have roll off. And probably won't be into the market until you start to get the magnitude of steepening that is in the ballpark of what exists in Japan already, right? You need, 80, 90 basis points of steepness in the US before you even get close. I think in the US case, the composition of the buyers has really shifted. Buyers that are much more, let's call it level sensitive rather than curve sensitive. Where you're getting, you can kind of see it in the sense of if you look at the flows into TLT relative to the yields, what you see is massive flows into TLT, right? The price of TLT, the TLT ETF, has gone down 50%, and yet the flows have never been stronger. It's like the total opposite of how stocks work, right? And that's so interesting because I think it indicates the fact that there's a broad-based set of demand from yield-sensitive buyers in the U.S. case, and that's what's really going to clear the market anytime soon is that demand. And that's why I think what we're seeing in the Treasury market, long end, is we keep bumping up to 5%, and we keep getting long end yield sensitive buyers coming in, and that's what's clearing the market. It's just that composition is just very different than it was, say, 3 years ago or something like that, 3 or 4 years ago, where the Japanese were critical components, the Japanese domestic lifers, et cetera, and pensions were critical purchasers of U.S. duration.
Bob, you obviously have tremendous experience both from the hedge fund industry, but now also running unlimited funds. So if you look at Japanese flows in global fixed income in sort of a historical context, how much value do you put on these trade flows from Japan? Is it something that you've monitored over your career?
Well, the Japanese, both the BOJ or MOF flows and reserves, and combined with the pension and lifers in Japan, if you look at the last 15 or 20 years, have been some of the biggest players in the U.S. duration markets out there. So they're critically important to understand. But like any buyers and sellers in these markets, they go through waves of activity, right? And so it's important to recognize what are their motivations, how are they behaving, and what are they likely to do given the dynamics. And so, on the margin, they were real supports. I don't know if you went back 5 years ago, they were real supports to the U.S. duration markets. Same with, even further before that, the Japanese MOF was a big support to the U.S. duration markets. They've largely been out. And so the real question, which many people have talked about, is who's picking up the slack in these international duration markets. And that's where I think a lot of people are looking at the market and saying, well, hey, we have big deficits and we don't have these foreign buyers because the yield curve's inverted. Who's going to come in? And the answer is like, what happens is the price changes, right? The price changes, and as a result, the yield changes, and as a result, the composition of the buyers or the demand changes as a function of that. And I like to talk about, I think a lot of people don't recognize how bond markets by themselves are typically self-correcting, very different from equity markets. Bond markets are self-correcting, which is what happens when you have big yield rises is that two important things that are self-correcting. One is the assets become more attractive, so you get more yield-sensitive buyers. And number two is that the rise in yields leads to less borrowing. And that's really important as well, because essentially that reduces the supply. I was just reading in the FT this morning on the way in about how corporates have they've stopped issuing bonds after this big rise in yields. Well, that is moving from an environment where there's a market sales of bonds to one where there's less sales. And so those two aspects mean that the bond market today at a 50 basis point term premium and a 5% yield is totally different from a bond market with a big negative yield term premium and a yield in the twos. Totally different markets, and you have to think about them totally differently as a function of that.
I was about to say, Bob, that Joe Biden hasn't gotten that memo yet, at least in terms of issuance. But speaking of that exact issuance from the US Treasury, we'll actually get an update from the US Treasury on the issuance pace. I think it's on Monday, right? So, Bob, any strong expectations for how the US Treasury will sort of deal with the duration profile, etc., in the quarters ahead?
Well, I think this is a really interesting moment because, from a policy-making perspective, I don't think anyone until like 3 months ago ever talked about the QRA. It's a critically important component. When you said QRA, people had no idea what we were talking about. And so, I think the main question here, and I think it's a really ambiguous question, is Janet Yellen going to act as a policymaker or a technician? And that's a really important distinction because a person sitting in the Treasury role could operate in either way, right? And when I say as a policymaker, she could easily take steps to make an impact on the Treasury market by increasing the bill share or the opposite, for instance, depending on preferences, right? And essentially act as a monetary policy tool in the quiver of the broader U.S. government. Or she can operate as a technician where there are guidelines. If you go back 5 years ago, no one looked at this because the guidelines were pretty clear. The issuance mix was pretty clear. It was just, here's the deficit, here's the mix, there you go. Just plug the numbers through and that's what you get. And so that's the real question is that sort of decision criteria, that reaction function, is Janet Yellen going to react? And I think there's a lot of ambiguity about that in the market right now.
And Bob, if I may, I wrote a piece on that actually just this week, and I would like to ask you if you were in Janet Yellen's shoes, given that you have an election year coming up, and I don't know about the new. Perhaps you can enlighten us a bit, but about the new Speaker of the House, I'm not sure that he's. I mean, I would be surprised if we see some lasting consensus on that score, and we will see some fiscal consolidation. But with all that in mind, what would you do if you were in Yellen's shoes at this point?
Well, I think what would I do is at some level not that relevant. I don't think anyone's going to be put me up as the head of the Treasury anytime soon. But a little too opinionated to navigate those political dynamics. I think a good. Yeah, that's way beyond me. The macroeconomy is hard enough, No need to challenge myself with politics on top of it. I think frankly, I think the best policy would be to maintain the technocratic nature of the Treasury, right? I think that's for decades and decades, the Treasury has served as a technocratic implementer of policy rather than a maker of policy on this dimension. And so I think that's the best path. My guess is that's what we're going to see, if I had to guess, but I don't have a particularly strong view, and more interested in just seeing what comes out of it, because I think that'll tell us a lot about whether this then becomes a policy making function of the federal government or an implementer of the existing policy mix.
Bob, I'll allow you one final comment on the matters on our side of the pond here in Europe as well. We've entered the quote-unquote widowmaker trade this week. We've added a clear duration bet to our portfolio in euro core bonds. So the idea seen from our side of the table is that the inflation picture looks much more benign actually in Europe, at least on forward-looking gauges relative to that inflation picture in the US. So what do you make of the distinctions in the inflation momentum around the globe? I know you track these things very thoroughly, Bob.
Yeah, well, I mean, I actually read your stuff carefully when it comes to the European inflation dynamics, and you've had for the last 18 months you've been all over it. So in some ways, I'd say what my view is meaningfully informed by what you're putting out on an ongoing basis. So take that. You could clip that as a little plug for your work. But I think that the basic idea that the inflation pressures in Europe are a little more contained than they are in the US. And I guess in trading the duration, I think the thing that's probably more interesting to me is that the supply issues are less extreme in Europe than they are in the US. And so I sort of put those two things together, and I think particularly on a relative basis, I find it pretty compelling to hold long end European duration relative to U.S. duration. I actually think it's possible on the other side that the policy mix is a little different. The U.S. rates have risen a fair amount more than European rates have. It's possible that won't play out on the short end, but on the long end, I feel like it looks like a pretty good diff trade. I like to think about bond markets and diffs, particularly because there could be global shocks and stuff like that. The last thing you want to do is have an unexpected long exposure to a big global growth shock or conflict shock or something like that. So the diff seems a little bit of a better trade than the outright from my perspective.
Final question, Bob. I have one more. I feel pretty certain that European inflation will be below 2% before New Year's. That's essentially our bet here. But if we ask you the same question in dollar markets, US inflation, will it even get below 2% before bouncing higher again in this cycle? What would be your impression looking forward 1-2 quarters here?
Yeah, well, I think the U.S. inflation situation, the basic question is the ordering. I think probably I'd say more. The question that's more interesting to me is, can U.S. inflation get to 2% durably without a significant economic deterioration? And I think the answer is no way. And so I think that then when you look at the mix of what's out there in the market. And the pricing, right, when you have such extreme equity market pricing, in terms of 25% earnings growth over the next 2 years, and that you have to have a meaningful economic weakness in order to get inflation back to the Fed's mandate, then you sort of put that together and you say, well, what's the big mispricing in the market? It looks like the big mispricing in the market is the equity market, right, which is not pricing in the likely weakness ahead. And so that's, going back to, I guess, the 7-step plan or whatever, 7-step progression, that's kind of how I think about the inflation problem in the U.S., relative to what's priced in.
Bob Elliott, the founder and CIO of Unlimited Funds. Always a great pleasure to host you. And if you're listening or watching the show out there, I strongly urge you to go follow Bob on either X, the old Twitter, or follow his work at Unlimited Funds. Bob, thank you very much for being with us again.
Hey, thanks for having me.
back from the interview with the great Bob Elliott of Unlimited Funds. Maybe we should start with concluding our top 3 favorite Bobs here. Because before I introduced Bob, I said that Bob Marley is my number 1, and I think Bob Elliott is he's number 3. But the second place is held by
Madoff.
Wait, his name is Bernie, right? But he was called Bob, right?
Sure, it's
but,
Bernie. It's not Bob. Madoff.
No, it was not. It was not Madoff I was talking about. I think the second place is up for maybe I think his name was Robert McNamara, but called Bob McNamara, the defense secretary during the Lyndon B. Johnson Vietnam campaign.
Back in the day,
yes. There's a very famous soundbite with Bob McNamara calling Lyndon B. Johnson, telling him that you cannot win this war. And Lyndon just responds by saying, I want more napalm thrown in their heads anyway, because I cannot stand to lose this war. So
I shall die him.
So in any case, Emil, trying to bring this discussion back to US Treasury markets, typically, I would argue that geopolitical turmoil, when push really comes to shove, is a sign to buy bonds. Yeah, you could at least argue that that has been the case through a couple of larger geopolitical events historically. So what do you make of that notion, that thesis right here, right now, given that, I mean, we are one hand grenade from a complete meltdown in the Middle East right now, right?
Yeah. So it's impaired by a couple of things. Firstly, perhaps, we should remember that the US imposed sanctions on both Russia and Afghanistan in recent years, meaning that there's a substantial risk that if you own US assets, you might end up losing them.
Yes.
So that has to be discounted into the treasury market.
And probably a reason why China has been net sellers of US Treasury to a certain extent.
Yes,
right?
and also because they want to diversify a bit, and they haven't really succeeded much in that effort. But that's probably a topic for another podcast. But and then secondly, the US economy is just keep performing, and it does so on the back of massive deficits. I mean, I think right now, I think the US is we're not far of basically Italian
standards.
No. Both when it comes to debt to GDP and budget deficit. So that's another part to have in mind. But still, at the end of the day, if gold has its day in the sunshine right now. I mean, it was actually trading a bit down in the back of the disinflation wave, but now it has really come back with a vengeance, right? And I think that once push comes to shove, I mean, everyone will pile in again. So I'm not super worried on a structural level, but we will probably see higher risk premiums going forward and higher equilibrium rates, but lower than what they are now.
And I think it's very fair to say, or safe to say, Emil, that based on our current assessment of the landscape in Europe relative to the US, we find euro duration much more attractive relative to dollar duration. I'm still a bit hesitant on that dollar duration bet, to be honest. I have literally also burnt my fingers on it a couple of times. So with the deficit still out of control, basically, with risk premiums on the rise, and term premiums on the rise as well. I think it's tricky to find the right timing, and I can assure you that if the tide turns, you'll have plenty of time to ride the wave. There's no reason to try and catch it before it starts, I think.
No, I think if you're levered into these positions, that's something to keep into account, right? And most people are after buying the long end, right? And you don't want to. I think that's why a lot of institutional investors are still on the sideline here, right? But if you're a cash buyer, put it in the drawer and just wait a quarter or two, and I think rates will be substantially lower. But you need to be capable of stomaching that, and big money can't, obviously. So I think that's where I'm at.
Emil, in relation to all of this, we've been talking about the potential for a so-called restocking cycle commencing.
Yeah.
A restocking cycle is basically characterized by orders increasing relative to low inventory levels.
Yes.
We've seen early signs of that in the US. The direction is still pretty clear on that story in the US. But what about the rest of the world? You follow China very closely for us.
Yeah.
Do we see signs of the same?
We actually do, but what we should take into account here is that process in China is usually heavily influenced by politics, and it is now as well. So it's not necessarily a sign of strong demand in the global economy. In fact, I will argue that the current restocking cycle that you see in China, you can see it in the production data and industrial output. It's actually sort of a desperate move to try to make up for losing volumes, right?
Yeah.
So, they're trying to keep their exports up, and they're suffering, and they have been done. They've been doing so for quite a while. I think when it comes to, say, Germany, it's more the case that we are just hitting the bottom, right? And we see some signs of life there, although they aren't. I mean, we're still talking depressed levels here, so don't get too cheerful about it. But we are seeing some reversal. And while in the US, it's just a case of its own. It's basically just the domestic engine that is the US economy just on.
And the Inflation Reduction Act fueling this restocking cycle as well.
Exactly.
So, if we look at the German case, I had a look at this ratio between the orders book and inventory levels of all subsectors in Germany. We have a couple of sectors actually improving now. Chemicals, first of all, typically the most cyclical sector on earth.
And energy sensitive.
Yeah, very energy sensitive. And secondly, also the auto industry. So there's also a small sign of life from Volkswagen, Mercedes, and Porsche. So the point here is, Emil, and that's what makes me really scared, is that those brief signs of life, and I put emphasis on small signs of life, they have already led to rising natural gas and electricity prices on a trend basis. So try to extrapolate this, say, with a 5 to 10% increase in the industrial output. Then I suppose that gas and electricity prices will be through the roof again.
Yeah, and add the uncertainty of weather here as well.
Yes.
Right? But a funny parallel here is that you mentioned the German auto industry, and you're right, they're actually showing some signs of a kickback here, but I would argue that it's actually a bit of the same dynamics that we see in China, because what is happening with car prices? Falling.
Yeah.
So what does that tell you? when output is slowly increasing, right? They need more flow in. But you're absolutely right. You're absolutely right that on the energy front, this could be a bit of a game changer. And remember, it trades on the margin, so small moves can make a whole lot of difference when it comes to price action. So that's something to keep aware of, definitely.
Yeah, and we remain long the very front end of the natural gas curve.
Yeah.
As a consequence of this, and we like the trade still. As of today, our models are actually getting increasingly bullish on this story.
Though it's volatile.
Yeah. You need to be able to stomach that.
We're in the money, but it's volatile.
Yeah. There is a spillover to a very interesting macro case for the week ahead, namely the Japanese yen and the Bank of Japan. So the Japanese yen is now trading above 150 in dollar yen terms, at least by the time of recording. But it seems like the level is now broken, this 150 handle, for good, or at least for now. Right? We've been banging the drum on the risk of the Bank of Japan meeting next week being a catalyst of further moves up in the dollar versus the yen. The point here, Emil, is that the Japanese yen is weak due to two major structural factors, in my view. One is that they import liquid natural gas like crazy. They still do, even though they're trying to diversify away from it. And Japan is essentially one of the most vulnerable energy targets out there from an import perspective. that's an issue for the Japanese yen as soon as we see signs of life
Yeah.
for higher energy prices and that rally. We've
Absolutely.
obviously seen that since summer, right? The second thing is that from a real interest rate perspective, especially if you look at the short end, the Japanese yen is probably the worst carry on earth.
Yeah.
That's not always an issue for a currency, but
No.
it is an issue for a currency when you add other structural negative factors to the mix, such as a trade deficit due to high energy prices, etc.
Yeah.
So it seems like the Japanese authorities are really struggling to find a good policy mix to deal with this.
Yeah.
Because they are trying to normalize policy, but yet they're not truly getting there.
Also, they are aware of the drivers of it. I mean, they're doing quite a bit to try to get some of the nuclear capacity back in action, right? To sort of limit the impact of the natural gas side of things. I think what they've been doing up until now, we had a podcast on it in August, right? I just got to know the gender of my son, who's coming in here. My wife's giving birth in December, and on the same day we shot that podcast, and
That's why you
came back
remember
from
it.
the hospital. So where was I getting? Oh yeah, I think they have been betting on importing disinflation, and to an extent that's a bet on low energy prices in the case of Japan. So far, that hasn't played out in their favor, but we are starting to see, I wouldn't say actual disinflationary momentum. In
At least stabilization. Yeah.
Yeah, I mean it's not panicky mode. So
No.
so I don't think they're really in that urgent state of affairs, but still markets are pushing them to try to do something about it, and I think there's a substantial risk that they will tweak the yield curve once more.
So here's a fun fact, Emil. If they move the needle on the inflation forecast again in the coming week, they will. They already warned us about that via sources in various news articles. They probably have to tweak the yield curve control in an upwards direction again. And when they do that, they're typically forced to buy a lot of local bonds to try and control the pace.
Yeah.
Because, I mean, if the US budget is vulnerable to large volatility in the treasuries, the Japanese budget is, I don't know,
mountain
3x, right?
Yeah.
It's a big struggle for them if the move in the long end of the yield curve is extreme and fast.
Yeah.
And that's why the Bank of Japan is obviously tasked with the job of trying to control the pace of things here.
Yeah, exactly.
And the fun fact is that despite them moving the yield curve control by 100 basis points, I think, all in all, over the course of 23, or since December 2022 at least, they are en route to buy a record amount of JGBs this year in their QE program. More than last year, more than 21, more than 20.
It's very paradoxical.
So they're buying more than they did during the pandemic.
Yeah.
That is why you get a weak currency when all other central banks are doing the exact opposite.
Yeah.
And if they move the needle on the yield curve control again, which as far as I can see, several members of the committee suggest that they do, then they will have to buy more. I think dollar yen is headed for 160. And then we may be discussing whether to reverse the view from there. But
remember, I agree with just about everything you just said. But remember, it's not necessarily an easy short here, because they will intervene and they will try to keep the rate of change here, especially in the bond market. I mean, the first shorts who piled in back in the summer, they got absolutely toasted. So keep that in mind. Keep that in mind for this trade.
Emil, final point of the week. You've been banging the drum on the risks surrounding the equity space for, say, 2-3 months.
Yeah, since August.
But we didn't really put our money where our mouths were.
No, we took it
at
off,
the time.
Actually.
We basically sidelined ourselves in equity space.
Yeah.
From a beta perspective.
Yeah.
But now we're net short. Why now?
A couple of factors. I think there's some technical arguments. S&P 500 breaking 200-day moving average on the downside, establishing a new ceiling. I think we sort of discussed this internally, that yes, Q3 was going to be a banger when it comes to economic performance, and that was to an extent also justified by some of the earnings, but you also saw a lot of stinkers, to be outright clear here. And I said, in any event, guidance is going to disappoint because demand and expectations of demand are going to get tweaked down. So that will obviously be reflected in the equity prices, and they're already in a rather depressing momentum actually since August. I think I just about called the top actually when we got out. You had to persuade me to get in, and I got us out. So nice deal on that one. And I think when this push comes on rates, which I think will sort of reestablish itself on the back of the QIA, because the amount of funding needed would surprise markets. That's going to cause some pain.
Yeah,
that's my
back
thesis.
to Bob's main point of the interview. The move seen in real interest rates has not been discounted in equities.
No, valuations are off the roof.
So unless you find it likely that we will get extreme growth in earnings from here,
be my guest.
Be my guest to take that view, then we either need a massive multiple expansion, or else equities will have to take some pain here.
Yeah, and I think another dynamic we should keep in mind here, and one of the reasons why we didn't go net short back then was that 2023 is a stupid year. And there's a lot of stupid mean reversals and dumb rallies and AI and whatnot. And I wouldn't be completely surprised if we see something to that extent, if indeed the long end of the yield curve starts to sort of regain some footing, and you have some dumbass piling into stocks to put it as it is. You've seen it with TLT. Why not the Nasdaq, right? It could happen. It's not my base case, but it's something to keep aware of. So shorting here is not necessarily a no-brainer and something you should do without thinking in mean reversal trends here. Yeah. So bear market traps and stuff. So keep that in mind.
Yeah. Very good summary to conclude this week's podcast with. Next week, Emil, we'll be back with a great guy from Tokyo, Western Nakamura, former Goldman, former Jefferies, Bank of Japan watcher, very active in trading Japanese yen markets. Yeah. So we'll obviously discuss everything around that Bank of Japan case with him after the conclusion of the meeting during the course of the week. Yeah. And I look very much forward to that. It's very tricky to find someone with a good knowledge of Japan and with the ability to actually present the views in plain English. Yeah. And Western is a very, very good cast for that.
Yeah, perfect.
So
difficult source to scrap up, eh?
Yeah. So lovely. I look very much forward to that. And as a final reminder, remember that the trade ideas just discussed in this podcast might be... That's our broad disclaimer. You don't get any lawyer to write it better than that. And remember that if you liked what you saw, if you like what you heard, use macro30, macro30 as the coupon code to get 30% off your subscription to stenoresearch.com. We have plenty of more stuff that we don't have time to discuss on this podcast. So go check it out. We'll leave the link in the show notes and also write the coupon code for you to use. Thank you very much again for listening and watching the Macro Sunday podcast. I'll see you again in a week.
Sometimes may be good, sometimes may be shit.